Well, let's go live now to Ottawa, where Bank of Canada Governor Tiff Macklem is discussing today's rate decision.
To 4.75%. We've come a long way in the fight against inflation, and our confidence that inflation will continue to move closer to the 2% target has increased in recent months. The considerable progress we've made restoring price stability is welcome news for Canadians. Since our monetary policy report in April, underlying inflation has continued to ease and economic growth has resumed. With the economy in excess supply, there is room for growth even as inflation continues to ease. Le Conseil de direction a convenu que la politique monétaire n'a plus besoin d'être aussi restrictive. Il a donc baissé le taux directeur de 25 points de base pour l'établir
policy interest rate by 25 basis points to 4.75%. We have made come a long way in the fight against inflation, and our confidence that inflation will continue to move closer to the 2% target has increased over recent months. The considerable progress we've made to restore price stability is welcome news for Canadians. Since our monetary policy report in April, underlying inflation has continued to ease and economic growth has resumed. With the economy in excess supply, there is now room for growth, even as inflation continues to recede.
Let me provide a little more detail around these dynamics. After stalling in the second half of last year, economic growth picked up in the first quarter of this year. At 1.7%, growth was lower than projected in the April report. But consumption growth was solid at about 3%, and business investment and housing activity also increased. In the labor market, businesses are continuing to hire workers. Employment has been growing, but at a slower pace than the working age population. This has allowed the supply of workers to catch up with job vacancies. Elevated wage pressures look to be moderating gradually. Inflation remains above the 2% target, and shelter price inflation is high. But total CPI inflation has declined consistently over the course of this year, and indicators of underlying inflation increasingly point to sustained easing. I'll highlight 4 indicators in particular. CPI inflation has eased from 3.4% in December to 2.7% in April. Our preferred measures of core inflation have come down from about 3.5% last December to about 2.75% in April. The 3-month rates of core inflation slowed from about 3.5% in December to under 2% in March and April. And the proportion of CPI components increasing faster than 3% is now close to its historical average, suggesting price increases are no longer unusually broad-based. This all means restrictive monetary policy is working to relieve price pressures. And with further and more sustained evidence underlying inflation is easing, monetary policy no longer needs to be as restrictive. In other words, it's appropriate to lower our policy interest rate. Si l'inflation continue à ralentir et que les données continuent à renforcer.
If inflation continues to ease and our confidence in that inflation is headed sustainably to the 2% target continues to increase, it is reasonable to expect further cuts to our policy interest rate. But we are taking our interest rate decisions one meeting at a time. We do not want monetary policy to be more restrictive than it needs to be to get inflation back to target. But if we lower our policy interest rate too quickly, we could jeopardize the progress that we have been able to make in fighting inflation. Further progress in bringing down inflation is likely to be uneven, and some risks remain. Inflation could be higher if global tensions escalate, if house prices in Canada rise faster than expected, or if wage growth remains high relative to productivity.
Continues to ease, and our confidence that inflation is headed sustainably to the 2% target continues to increase. It is reasonable to expect further cuts in our policy interest rate. but we are taking our interest rate decisions one meeting at a time. We don't want monetary policy to be more restrictive than it needs to be to get inflation back to target. But if we lower our policy rate too quickly, we could jeopardize the hard-won progress we've made. Further progress in bringing inflation down is likely to be uneven and risks remain. Inflation could be higher if global tensions escalate, if house prices in Canada rise faster than expected, or if wage growth remains high relative to productivity. In assessing where inflation is headed, we will continue to closely watch the evolution of core inflation. We remain focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. With that summary, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Okay, thank you, Governor. Let's just quickly go over the ground rules. We're going to start here in the room in Ottawa and then go to the phones. I've got quite a long list, so let's limit it to one question, please, per outlet. If I forget to do so, please state your name and affiliation. For those who are new here in the room, please press the green button on the little box in front of you to activate your microphone. Press it again to shut it off once you've done asking your question. Avant de poser une question, veuillez vous identifier et
identify yourself before asking your question, and as usual, please ask your question in the language of your choice.
Start up here up front with Jordan Gowling from CTV, please.
You previously said that you won't be cutting rates at the rate that you raise them. Does this mean Canadians should not expect a cut next month, or do you plan to cut again in July?
Look, I think the message is pretty clear. We're going to be taking our interest rate decisions one meeting at a time. If the economy continues to evolve broadly as we had expected, if we continue to see inflation pressures easing, it is reasonable to expect that there will be further cuts in interest rates. But the timing of those cuts, or of any further cuts, are going to depend on incoming data and our assessment of what those data mean for the future path of inflation. Look, we are determined to get inflation back to the 2% target. At 2.7%, we're still above target. There are a number of risks that we're watching closely. So, you know, the work's not done. We're going to be seeing how things evolve and taking our decisions one meeting at a time.
Let's go now to Promit Mukherjee from Reuters, please.
Thanks, Paul. Hi, Mr. Governor. I would like to again take it forward, that question. Considering that so far the data has shown that the inflation has been easing and it's going in the trajectory that you wanted. If it continues in that way and you will have more numbers in terms of GDP and job by July 24th, if that all continues the way you want it, do we see a rate cut in July?
I'll get to the going ahead, but let's just enjoy the moment for a bit. Let me just say a couple of key points about the rate decision today, and then I will come back to where we could be headed. But look, a couple key messages today. We've come a long way in the fight against inflation. Headline inflation has come down, our measures of underlying inflation have been easing, and growth has resumed again in the Canadian economy. The second key point is the economy has evolved broadly the economy has evolved broadly as we've expected in recent months, and that has increased our confidence that inflation will continue to move gradually back closer to the 2% target. So we decided at this meeting that monetary policy doesn't need to be as restrictive as it has been. And we lowered the policy rate by a quarter point. I know this is welcome news to many Canadians. I also know everybody wants to know, okay, where are we headed? That is going to depend how things evolve. What I can say is that if the economy continues to evolve broadly as we expect, and we continue to see a broad easing in inflationary pressures, it is reasonable to expect further cuts in our policy rate. But and I want to stress this, the timing of any further cuts is going to depend on incoming data. In particular, is going to depend on what those incoming data tell us about the most likely future path for inflation. We are determined to get inflation back to the 2% target. We know there can be some bumps along the way. There are a number of risks, which I highlighted in the opening statement, which we're watching closely. So what does all that mean? It means we're going to be taking it one meeting at a time.
Paul Vieira from the Wall Street Journal, please.
In testimony to lawmakers last month, you talked about how
We've been listening to Bank of Canada Governor Tiff Macklem taking questions from reporters and getting some reaction to today's rate decision. We'll have a lot more on that breaking news throughout the morning and afternoon.